Every file in this series has a moment where the money changes direction, where a company stops being a business and starts being a source. This file is different because in this one, that moment happened on day one. In 2004, a group of investors bought a department store chain called Mervyns, and before the ink was dry, they had split it in two, a retail company that ran the stores and a property company that owned the buildings, both controlled by the same owners. From that day forward, Mervyns paid rent to its own buyers on stores it used to own, at rates its creditors would later call inflated. 4 years later, Mervyns was liquidated, 18,000 jobs, gone. And here's the sentence that earns this story a file of its own. According to the reporting on the aftermath, the owner's profits from the real estate and dividends exceeded their losses on the retail side. The company died. The deal worked. This is the liquidation files. Open the folder. If you grew up west of the Rockies, you don't need Mervyns explained. Founded in 1949 by a merchant named Mervyn Morris in the Bay Area, the apostrophe was real. It was his store. Mervyns grew into the middle-class department store of the American West. School clothes in August, Levi's on the shelves, a step up from discount, a step below fancy. It was so good at that middle lane that in 1978, the Dayton-Hudson Corporation, the company that would become Target, bought it and ran it as a sibling brand for a quarter century. By the early 2000s, Mervyns was aging, and Target wanted to focus on its own bullseye. So in September 2004, Target sold Mervyns, 257 stores, roughly 30,000 employees, to a consortium of investment firms for about $1.25 billion. Cerberus Capital, Sun Capital Partners, and the real estate specialists, Lubert Adler and Claff Partners. Notice who was in that buying group because it explains everything that follows. Not retail operators, distressed investment firms and real estate investors, and look at how they paid. Roughly $400 million of their own equity and $800 million borrowed against Mervyns real estate itself, the chain's own land and buildings, mortgaged to buy the chain. If you've been with this series since Red Lobster, you know that move. But Mervyns added a refinement that makes it the purest specimen in our files. On essentially day one, the new owners divided Mervyns into two entities. The retail business, registers, inventory, and employees went into an operating company. The real estate, the stores Mervyns had accumulated over half a century, including prime California locations, went into separate property entities under the same ownership. In the trade, this is called an opco-propco structure. And here's the honest disclosure, there is nothing automatically illegal about it. Companies do it for financing and tax reasons all the time. The structure isn't the crime. The structure is the opportunity. What matters is what the owners do with it, because the moment the split happens, the same people control both sides of a lease, the tenant's checkbook and the landlord's invoice. According to the lawsuit Mervyns creditors later filed, here is what was done with it. The property side charged the retail side rent, and the creditors alleged those rents were raised above what Mervyns had effectively been paying before, siphoning the retailer's cash into the owner's property entities month after month. Every dollar of rent increase was, functionally, the owners paying themselves out of the store's registers. Meanwhile, according to bankruptcy court filings, the owners collected roughly $200 million in fees and dividends in just the first 2 years. And remember the $800 million borrowed against the real estate at purchase, money that had gone to Target, not into the stores. The retail company was now smaller, poorer, rent-burdened, and stripped of the asset cushion that had always stood behind it. The safety net hadn't disappeared. It had moved into entities the creditors couldn't reach. For a while, the machine hummed along invisibly. Mervyns kept selling school clothes. Its final full year, it still did $2.5 billion in sales. But it was losing money, a $64 million net loss, and it now lived with no margin for error in a structure specifically designed so that errors landed on the retail side. Then 2008 arrived, and the financial crisis found every retailer in America living paycheck to paycheck. The difference was that Mervyns had been made to live paycheck to paycheck. On July 29, 2008, Mervyns filed for Chapter 11. There was no rescue, no buyer, no reorganization. By the end of that year, all 175 remaining stores were liquidated. 18,000 people lost their jobs in the middle of the worst job market in a generation. And then Mervyns, or what remained of it, did something remarkable. It sued everyone. The estate and its creditors, the vendors like Levi Strauss who had shipped clothes they were never paid for, filed suit against the private equity buyers, the banks, and Target itself, alleging that the 2004 deal was a fraudulent transfer, that carving the real estate out of Mervyns had rendered it insolvent, that the rents were inflated, that the fees and dividends were taken from a company that could not afford them. The defendants denied all of it, maintaining Mervyns was solvent and adequately capitalized after the deal. Target fought to be dismissed from the case, and the court said no, Target stays. 4 years of litigation later, in 2012, the buyers and banks settled, $166 million paid to the creditors, plus the withdrawal of hundreds of millions in claims the funds had made against the estate, with, as always in these files, no admission of wrongdoing. At the time, it was described as one of the largest settlements creditors had ever extracted from private equity firms, and observers called it a potential game-changer, proof that the OpCo-PropCo split could cost its architects something. One veteran retail analyst put the epitaph plainly in the coverage. Mervyns was struggling in 2004, but it might have had a shot at a turnaround. The fees the firms took out, he said, were really the death knell. But here's the number that number can't fix, the one from the top of this file. Even after the settlement, the arithmetic of the deal, as reported in the aftermath, favored the buyers. The profits from the real estate transactions and the dividends exceeded what they lost when the retailer collapsed. Sit with that, because it's the cleanest demonstration this series will ever give you of the core mechanism. In every previous file, you could squint and tell yourself the owners wanted the company to survive, that the extraction was greedy, but the death was accidental. Mervyns is the file where the structure itself made survival optional. Once the real estate was out and the rent was flowing, the owners held a position that paid off in both futures. If the stores thrived, they collected rent from a healthy tenant. If the stores died, they kept the property and the dividends and walked away net positive. Heads, they win. Tails, 18,000 people lose. If this structure sounds familiar, it should. You've seen its descendants all over this series. Sears CEO chairing the landlord that collected Sears's rent. Red Lobster paying rent on buildings it built. The difference is that those extractions took years to assemble. Mervyns was born into it. The split happened at the moment of purchase, which is why creditors and courts spent 4 years arguing about whether the company was ever really solvent again after the first morning of its new life. So let's close the file with the lesson Mervyns adds to our shelf. When you evaluate who killed a company, don't just ask who owned it. Ask what they owned next to it. An owner who holds only the company needs the company to live. An owner who also holds its buildings, its debt, or its landlord doesn't. The Mervyns buyers built a position where the store's death was survivable for them from the first day. And when a death is survivable for the people in charge, this series keeps finding. It has a way of arriving. Somewhere out there, Mervyn Morris's apostrophe is still on old signs in strip malls the property entities sold long ago. The store lasted 59 years. The structure that killed it took one afternoon to build. If you want more files like this one, the companies you grew up with, and the deals that quietly hollowed them out, that's what we do here at the Liquidation Files. The next file is already open. I'll see you in that one.